Welcome back to Switzer. It's now time to catch up with Professor Ron Bewley to see what his number crunching is telling him about the sectors that have the most potential going forward. Ron joins me in the studio. Hey, Ron.
How are you?
Good to see you, mate. Now, we won't muck around. I always like to try as much in as possible. You always like to start with charts. The first chart
But an intro first before the first chart's been made.
It's your spot. The intro.
Because often in my world, nothing changes for a while, and then something does change. This is a point where something important has changed, and I want to share that with you.
Okay.
You might remember, I hope you remember, 2-3 months ago,
yes,
I said I thought the analysts got the materials sector wrong, and that was bringing the forecast for materials down, and it was bringing the ASX forecast down with it. But I said, at some point, I think they'll redo this, whatever, and that's what this is about, and therefore how you react to it. And even better, I think, instead of the yield portfolio that's on your website, which was updated last week, this is my hot chip portfolio. It's
hot shot or hot chip?
Hot chip.
Hot chip
there's
portfolio.
Blue chip.
Okay.
So this is the hot one. The ones which are better, and it seems to have been worked.
Get your pens out, ladies and gentlemen. Ron's got his hot chip portfolio.
And there's a version on my website with more detail because it was too busy, so I took some stuff out.
Okay.
So chart one, if we may.
Okay, chart one, if we may. And this is selected sector capital gains forecasts.
And what I've done here is I've missed out 8 of the sectors because there's not enough room.
Okay.
And they're boring.
All right. Energy, materials, industrials.
Yes. Materials is the big one. Look at the way it fell from 9% at the start of the year.
Blue is quarter 1, right?
Yeah. And then it goes down to yellow, which is effectively 0. It actually went negative at one point. This is when we were talking about it. And look, it's just jumped up in the last few weeks. Back up to almost where it was at the beginning of the year. Energy's come down but stabilised. Industrials has just come off. And if you look at the important thing for what we were talking about, the ASX 200, the forecast was 8.8 at the beginning of the year. That got down to about 5.8, and it was looking a bit sad, but it's now up to 7.7.
So you're more positive than last time you were here?
Yes.
Yeah, so you worried me a little bit, Ron. You're a little bit more negative.
I tell what I see to be the truth.
Precisely.
That's all I can do.
Yeah, and what's intriguing there, materials had a bit of a troubled time, but you're saying, because these are capital gain forecasts, what you think will happen to the share prices of
the next 12
companies in
months.
these sectors over the next 12 months. Okay.
Plus they get a bit extra because they're underpriced at the
So
moment.
you've got the ASX 200 for people who play ETFs. You got up about what, 8%?
7.7, but it's actually underpriced, so it's going to be more like a 9.5, not 10, plus the dividends. Things are looking good again.
Yeah.
And I want to show
I'm
you
glad to have you back on the show.
How to react to it. But there's no point in bullshitting.
No,
anyway,
I know.
So I do all my jiggery pokering. If people read your website, the Switzer Super, I talk about how I build portfolios. I can't go through that. But this is a portfolio that's taking benefits.
This is number 2.
Yes, of these. It's taking the benefits of all these changes that are going on. And importantly, really importantly, for the whole year, I build a new portfolio every month. There were no exposures to material stocks.
Right.
Suddenly, there's
materials
12%.
Are back.
12% gone from 0 to 12, so this is a big change.
So all these companies in here,
they're the ones I pick.
They're the ones you pick.
Well, sorry, my little model
picks. Portfolio.
Yes.
So these are companies that you think have upside. You wouldn't have them here if they didn't have upside.
Well, the brokers think they've got upside.
Yeah, because you analyse the analysts.
So it's not really my opinion.
No.
It's my opinion how I should interpret them. And importantly, you were grilling Simon Bond. I was watching that about which ones would you choose. Well, to me, it's like in a cooking show. You wouldn't say what's my favourite ingredients. I wouldn't say meat. It's how you put the whole thing together. I need that much meat, that much spice, that much potato, whatever. So unless you put these together, they're no good. And that's the conclusion at the end if we can get to it.
Okay, right. We will.
So
if somebody just came along and said, I'm going to buy Horizon, they might not get the same kind of result if they bought the whole portfolio, you're saying?
Because there's a big risk in each one. These are riskier than the blue chips.
Yeah.
But these will fit together better.
And you got 1, 2, 3, 4, 5, 6, 7, about 10% exposure each one. Yep.
And I've only given the sector weights because there wasn't room. But on my website, you get the weights for each stock.
Okay.
Yeah. So what you can see here, there's 4 stocks in energy, and there's 3 in materials. And in my yield portfolio, there's none in either. So it matters what you're trying to achieve. And here, I want much outperformance in capital gains, stuff the dividends.
Okay. Now, so Ron, you got your energy, materials, industrials. What are these companies down the right-hand side?
So these more sectors, discretionary staples.
Oh, of course, yes.
I tried to get. I did this again. I read it this morning. I'm trying to fit a lot of stuff on one page so you can see it. So they're the different sectors. So there's 11 sectors, but there's no utilities in this portfolio. So you only see 10.
Yeah.
So Tassel, that apparently, or how you pronounce it, imports salmon and stuff like that, and that's our staples choice, and that gets quite a big weight in it.
Yeah. Well, also, so you're taking a punt on Singtel.
Yep. No, but I'm not. But you see,
Analysts are.
But you don't know which ones the analysts. The analysts think it's good, and they could well be wrong, but they don't all have to be right. That's what I keep saying. All you need is to beat the market. You don't have to be the best in the universe.
Okay.
So, if you now turn over.
This is number 3, performance data, capital gains.
So, every month I build a new portfolio. And in my yield portfolio, it doesn't change much from month to month because it's looking for bigger stocks, it's looking for dividends that are slower moving.
Right. Okay.
These guys change because the weights for the sectors change and the current hot stock changes.
So the hot chip are the red, the blue is the ASX, and you're showing that they've outperformed.
Every one of them, they're quite different. Massively outperformed, some of them. And interestingly to me...
But Ron, for someone to actually tap into this, are you saying that they would have to actually change their portfolio every month?
No.
No?
No, they don't. I was going to get to that later.
Okay.
For my yield, I think you can probably wait a year before you change it.
This one, stable.
You would certainly think about seriously changing after 6 months. But if something went wrong, you'd be thinking in terms of like a stop loss.
Right.
If something went a bit wobbly.
So the one we see here in February was identical to the March one?
No, totally different portfolio.
Okay.
Not totally different, sorry. There's overlap.
Okay, but if I bought into the February one, you're saying you could probably hold that for 6 months.
And if you did, you would have got 16%.
Okay.
Because there's too much fluffing around in the buying and selling.
Over what period? Over an annual?
Till today, or till last week, I think it was.
So these are all until today.
So the first red is to 7 months, the next one's 6 months, next one's 5, 4, 3, 2, 1.
Okay.
And the September one hasn't got going yet. It's only had a few days.
And so the February one is the biggest because it's been in there longest.
Yeah.
Okay, good.
But interestingly, all be. But
remember, I've got to ask questions for viewers who are at home wondering what in the hell these charts are about.
But it's just exciting. Just
I know it is. I can see you.
But I did this at the bank, and in 2006 and 7.
The bank, you mean CBA, when you were head of private investment research.
And it really, all of these things really worked well until the GFC.
Yeah.
But you shouldn't be in a portfolio like this when a GFC comes along. If you're going to lose.
No analyst could pick it, so no analyst is going to be right.
Yeah, but you see it coming when in January when things went long, you should have just sold.
Yeah.
Keep your high conviction portfolio maybe, but sell this one. Yeah. So keep your eye on that.
Okay.
So we've had, but of course, the old disclaimer: the next one may not work. But what I've got on slide 4.
Slide 4. This is the March hot chip 6 months.
So this is the one you saw before
the chart,
the current one.
Yeah.
And the reason I want to put this one up, so I don't want any smoke and mirrors. Yeah. Not all stocks do well, and you can see that
Decmil didn't do
March. Well,
Skilled didn't do it.
Burrow was 34% down. I think it's down further since.
Yeah, yeah.
Skilled you wouldn't like. Decmil or whatever, I don't know what it does. Yeah. But some of them did really well on average. You're getting like an extra 5% out of this. So if you chose to only pick half of them, you might just pick the half with the whatever.
Bad half or good half.
There's something in the process that tries to allow for all of that. So this one is the gain up to 6 months. And what I would recommend to myself, because I'm going to buy one of these, I didn't tell you that. So next month, I'm going to buy next month's. Because I want something besides my yield play outside my portfolio. Yeah. So.
And next month will be a whole different collection.
It could be the same.
Could be the same.
But it could be very different.
Okay. But it'll all be based on what analysts are telling you.
And it's exactly the same process, the same formula, the same everything. It's just that the analysts and the data have changed their mind. So then I refresh it. And as I did in your website last week, occasionally I compare the old one that I buy with the new one to see how different it is. Is that a red flag? Should I be thinking about changing? If it's similar, what's the point?
Okay, right.
So have we got a minute?
Yes, yes.
So if I'd bought this one, I wouldn't have waited to lose 34% on Burrow.
Yeah.
Lose 10 or 15 and say goodbye to it.
That's your exit strategy, 10 or 15?
Yeah, you got to get, and then just leave it in cash or something like that. Yeah. Don't go around looking for the next best thing. You made a mistake. And therefore, you could limit the downside by doing. Obviously, sometimes they go down 34% in one day.
I'm thinking to myself, there are people at home excited about what you're saying, but not fully understanding it, Ron. What's the best way for them to get a fuller explanation of all this?
If they read the Switzer Super Report, the last 13 issues, I think it is, that I put on, they'll see how I construct portfolios, what I do and why I do it. Yeah. And in the last one, I even mentioned this and how it differs.
So the last one, which will be on our website.
Last Thursday.
Yeah. That will give them a pretty good idea.
Yeah. And some of my stuff, it's on my website.
Follow on your website as well.
So, but This isn't like a real kick the lights out portfolio. Every stock comes in the top 200. Yeah?
Yeah.
So it's not real mega risk, and you've got diversification, but it's much riskier. You wouldn't put it in a super fund.
So for the last thing before we go then, even if someone doesn't take the courage to go into these hot chip portfolios.
Although they should be, a lot of things.
But if they do, but you're also saying that you think the market has more upside now than you did, say, 3 months ago.
Yes, and because the market's very underpriced, it's given me an extra double whammy, and that's why, unless things get really good over the next couple of weeks, next month is the great time to come in and start buying these things, and hopefully looking for a couple of 20%ers.
Ron, always good to see you. Okay.
Nice to see you.
That's the show for tonight. Ron Bewley has done his usual extreme work on finding good stocks for you to have a look at, but particularly good portfolios. Thanks for joining us on the show. I'll see you tomorrow night.